Hope everyone's having a great Tuesday. We're so excited to bring in First Element Insurance Planners today. Great. Thank you, everyone, for joining us today. I'm Betsy Reeves. I am the marketing coordinator here at Elevate Wealth Advisory. And first, a few housekeeping items. We love to do these webinars every month, and we focus on different topics that our clients have told us that they care about. And one of those topics recently has been long-term care insurance planning. How much does it cost? Is it worth it? How much do I need to save? What does it cover? And here at Elevate Wealth Advisory, we like to sit down with our clients and understand their goals for their entire life. And because we don't focus particularly on long-term care insurance planning, we were connected a few years ago with First Element Insurance Planners, and we found that they align closely with our philosophy here at Elevate Wealth as fiduciaries. And we are so honored to have Dan Sullivan and Michael Tessler with First Element Insurance Planners with us today to discuss the ins and outs of long-term care insurance planning. Throughout today's discussion, if you have any questions at all for our speaker, you can put them in the chat box or the Q&A box, and you'll find both of those at the bottom of your screen. At the end of the talk, I'll go ahead and read those questions to Michael, and he'll get back to you either through this webinar or through email with all the answers to your questions. And then in a couple hours, I'll upload this webinar to our YouTube channel. And that way you can go back and watch if you have any questions that weren't answered. You can also share it with family and friends that you think might find it helpful. And here we are with Dan and Michael. Michael is the president at BUI. For over 3 decades, Michael's partnered with financial professionals to implement wealth transfer and wealth protection strategies. In addition to appearing in numerous publications, Michael commonly speaks to thousands of insurance advisors, financial planners like us, attorneys, accountants, and the like about various planning strategies utilizing life insurance and long-term care insurance. When Michael isn't helping financial professionals implement the best planning strategies for their clients, you can find him spending time with his beautiful family or playing tennis. Welcome, Michael.
Thank you, and good morning to everyone. Appreciate that very, very kind introduction, and appreciate the opportunity to be with all of you. Today, I'm in St. Louis, Missouri, where if you have been watching the national news, you know that we've been blessed with a foot of rain overnight, which is taxing just about everything here in St. Louis as much as it could be taxed. So an interesting start to my day here. But delighted to be with all of you. So our discussion today is meant to be purely educational. You will not hear the name of any insurance company or any insurance company's product. What we want to talk about today are why you want to have a plan as it relates to chronic care and the impacts of those things. Now, I could start this meeting with literally dozens of slides filled with statistics like these about the percentage of people that will need care and how the care will affect them and their families and their finances. I mean, the statistical data around this is absolutely overwhelming, and it goes on and on and on. However, that's not, no matter how much statistical data there is, that's not the real reason that people like to prepare for a chronic care situation. And what it really comes down to is understanding why this is important to you. And the reasons start with the fact that you've spent your life taking care of people that you love. And in fact, for many of you, your sense of purpose has been to take care of your family, and understandably so. You've made a commitment to take care of them in such a way that it brings you a great source of pride and well-being. In fact, it's part of the meaning of life for you. And it really goes down to some of your most primal instincts to take care of those people, your family, and protect those people. And it is these kinds of consequences that you would do this even to the detriment of your own health. A parent who would, do whatever it took to save a child kind of a situation. And the reason that people do this planning is understanding the consequences that a chronic care or long-term care type situation will have on them and their family. Um, the first is understanding what providing care does to caregivers. Whether it's a spouse or a child, the reality is that providing the care is incredibly difficult for the caregiver. And in many instances, it will make a caregiver um, literally ill themselves. It's about knowing that you've got a family member who's going to have to put their life on hold, and especially when it comes to children, understanding that their family, the things that they're working to build and grow and what have you, are all going to have to be put on hold as they have to provide care for a parent. It's knowing that siblings rarely share this. And in fact, in many instances, this is not something that brings siblings together. In fact, it actually tears siblings apart. And the reason is because in this world in which we live, very rarely are all the kids in the same city. Very rarely are they all in the same financial situation. Very rarely do they all have the same connection to their parents. And what inevitably happens is in a sibling situation, there is one sibling, maybe more than one, depending upon how many there are, that ends up shouldering a huge part of the burden, which many times causes resentment among siblings. And it even causes the kinds of things that go on for generations. When two siblings decide that they're no longer wish um, to speak to one another, it means that their children don't get exposed to each other. So now cousins, first cousins, et cetera, are not spending time with one another because siblings have, in fact, come apart as it relates to providing this type of care. And it's really significant when you get to families that have multiple marriages in there. Who's responsible for what, which child, whose money, their money, his money, her money, always gets really, really complicated when we start talking about multiple marriage situations. And so when you look at the consequences of a chronic care situation, the impact that it has on the family in terms of their health, in terms of relationships with one another, et cetera, the consequences are so great that most people want to make sure that they've got a plan in place for something that is so likely to become a part of their lives. So, in addition to the impact that it has on the people that you care most about, it obviously can have a significant impact on your finances. And it really comes down to, for people who are still in their working years, a reallocation of your income. What are you paying for now that you won't be paying for because you have to redirect that money for a care situation? And as you're likely aware, most people live on all or most of what they earn. And as a result, it's not like there's an easy way to start shifting money to make it easy to pay for something. You then start looking at which of your financial commitments will have to change. As an example, if you are caring for a child who may not have made the best life decisions and needs your assistance, will you still be able to do that? Will you be able to contribute to the college or high school education programs for your children or grandchildren? Are you giving to a particular charity that's important to you? Do you have hobbies that are important to you? Do you like to take the family on vacations? There are so many things that you look at and say, if something happens and significant financial resources are needed to provide care, which things in my life are going to have to change? So the most important thing that I'm going to tell you today is not that you need long-term care insurance. The most important thing that I'm going to tell you today, and the thing that I hope you will take away from our talk today, is that you need a plan. And you should be talking with your financial advisor about a plan. Now, I would also submit to you that in that plan, I think insurance plays a really important role, but that's something that you have to decide for yourself and decide with your financial advisor if insurance should play a role in your plan. But remember, the most important thing is have a plan. I can tell you, I have seen this way too many times. Those who are most deeply impacted by a chronic care situations are the ones that got surprised, didn't have a plan, had not taken any steps as it relates to having a chronic care plan. So what does long-term care insurance do? Specifically, and I could give you lots of definitions, but let me tell you what it does. It covers the things that your other insurance doesn't cover. So if you are still in your working years and you are on a medical insurance plan from your employer, or if you are retired and you are on Medicare and perhaps have a Medicare supplement policy, in either of those two situations, those insurance coverages are not going to cover a chronic care situation. If you're injured, if you're ill, if you need a hospital, if you need a doctor, they're covered by your medical insurance and by your Medicare. But if you are not any of those things, but you also can't take care of yourself, that's not going to be covered by your medical insurance plan, nor is it going to be covered by Medicare or a Medicare supplement plan. So understanding that this is the insurance that covers what your other insurance doesn't cover. How does one qualify for benefits in a long-term care insurance plan? There are two primary ways. The first is if somebody becomes cognitively impaired, and usually what we are talking about here is Alzheimer's and dementia. And it's important to understand that Alzheimer's and dementia are not only the most significant cognitive impairments, but these are also the situations that cause somebody to need care for the longest period of time and for some of the most expensive care that is needed out there. And unfortunately, as I speak in front of a lot of audiences, very, very few audiences have people in them whose lives have not been impacted by dementia or Alzheimer's. I can also tell you that no matter how large the group of people that I'm in front of is, whether I'm talking to a group of 10 or a group of 1,000, when I say how many people in here have been impacted by a chronic care situation, and I know we're virtual now, I keep saying here as if we're all in the room together, but how many people have been impacted? Every hand on the video call or in the room goes up that, yes, I have been impacted by a chronic care situation. The second way that people qualify for benefits is if they are no longer able to do 2 of 6 activities of daily living. Those 6 activities of daily living are up on the slide that's in front of you. And so while you don't need a doctor, so you're not going to qualify, as I said, for other insurance, but you also can't bathe yourself or can't feed yourself or any of the others here, that's where your long-term care policy would provide benefits. So it's not one or it's not both, it's one or the other, either a cognitive impairment or the inability to do 2 of 6 activities of daily living. In either situation, the insurance company will reach out to your primary care physician to get confirmation that you, in fact, have a cognitive impairment or that you're unable to do 2 of 6 activities of daily living. So that's basically how one qualifies for benefits under a long-term care policy. There are 2 ways that benefits are paid. The first one is what we refer to as an indemnity plan. In other words, an indemnity plan pays however much benefit is due. If somebody has a $5,000 long-term care benefit that is payable, if they qualify under an indemnity plan, they get the $5,000. If somebody has a reimbursement plan, then the insurance company will require you to provide receipts for the care that is being provided. And if you have $5,000 or more in receipts, they will pay you the whole $5,000. If you have less than $5,000, let's say, as most people do, they don't immediately go in and need all the care in the world. Sometimes it's more of a gradual thing. Need somebody to come into the house a couple of times a week and help out. It could be that it's only costing maybe a couple of $1,000s a month. The good news on the reimbursement plan is that unused portion, in other words, if you have a 5,000 benefit and you're only using 2,000, the unused portion being the 3,000, stays in the pool of money that is available for care. So it's not that it goes away, it's still there for somebody to use, just a different way in which these two plans are handled. If you think that you have a child who might have to leave their job, for example, to provide care for you, then an indemnity policy might be a preferred option, in that the insurance company pays the money either way. How you use the money is entirely up to you. If you only use $2,000 a month of the money, it's going to be up to you or those caring for you to then put the other $3,000 aside and hold on to it for potential future costs. There are two types of plans in the market. There's a traditional and a hybrid plan, and we're going to spend some time talking about both. A traditional plan is the oldest plan that's available, that's been around in the market. It's generally pretty customizable. It starts out very, very affordable. Unfortunately, however, the premium amounts and the the long-term care benefits on these plans are not guaranteed, which means that the insurance company can, and take my word for this, will increase the costs on these plans. And to be honest with you, if you look back in history, there has been a significant rate increase on these plans. So we're not talking about it going up 3 or 4 or 5%. We're talking about it going up 100 or even 200% and still increasing. One of the things that some people have suggested that they're not fond of with a traditional plan is the idea of use it or lose it. You buy the plan, say in your 50s, you hang on to it till you're in your 80s, you pass away without ever having needed the care, and all the money that went into the plan is spent and goes away. There's no residual value, there's no death benefit, nothing like that. I'm not personally, that one doesn't bother me so much. For example, if I have automobile insurance and I pay for a year of coverage and at the end of the year my car wasn't wrecked or stolen, I'm not disappointed. But for some people, that has been on their minds as it relates to the amount of premium that they're going to spend on a traditional plan. I spoke about the rate increases, and this is a very real situation, and I never do one of these presentations where somebody doesn't at some point ask a question about their existing plan where they have had massive rate increases. I know this slide is very small, and I absolutely do not expect you to be able to read this slide, but I want to point out this is a real letter. It was used almost 10 years ago, and it is still used today, the exact same letter. This comes from a company that has the largest block of traditional long-term care insurance in the country. And if you read this letter, or if you can read it, and I don't blame you if you can't, right here it's telling you this client is getting a 50% rate increase. And that's a pretty significant cost increase. And what this rest of this letter is telling you is that you have options. You can just pay the 50% rate increase and watch your premium go up. Or you could choose with one of these other options to lower your benefits to help you stay at or near where your cost was when you purchased this plan. You may have noticed the date on this thing is from 2016. And interestingly enough, this person, by the way, their names and information have been removed for obvious reasons, this person has already had another one of these letters show up with additional rate increases. So those who have traditional plans need to expect very, very large rate increases if they buy such a plan. Interestingly enough, if you go back 20-some years, traditional plans were by far the most popular plans, where hybrid plans were a very small part. Going forward, and forgive me, we don't have the more years on this thing, but as you can see, hybrid plans dwarf the number of traditional plans that are purchased by people, and there's a reason why. So let's talk about hybrid plans. Hybrid plans are a marriage between a life insurance and a long-term care insurance plan. Nobody buys these for life insurance, although the death benefit does play a role here. What they do buy these for are the really important guarantees that come with it. A hybrid long-term care plan will guarantee the premium for the rest of your life. It will guarantee the long-term care benefits for the rest of your life. It will guarantee the life insurance. And again, nobody buys it for life insurance, but if you're one of the lucky ones who never has to use the long-term care, it's nice that there's something left in the end. And most of the plans in the market also guarantee cash value, in some instances, a complete return of the amount of premium that you have put in. So I'm not going to get too specific on all of that because features and benefits do differ from company to company and plan to plan. But generally speaking, these are features and benefits of the better hybrid plans in the market. There are a variety of payment options with these plans. You could pay it off all at once. You could pay it over 5 years or 10 years or for the rest of your life. And for many people, that's just a personal decision on what makes the most sense based on their financial circumstances. There are also some other alternatives to how these plans might be funded. For some, they have existing and old permanent life insurance contracts that they may have purchased when their children were very young and they were worried about passing away and needing that death benefit to take care of their children. Now they've reached a point in their life where their children are all grown and out of the house and have families of their own. They're no longer worried about dying too soon, but what they are worried about is living too long, so to speak, and needing care. Many times the cash value from those existing policies can be used as a funding mechanism to with a hybrid long-term care plan. So in many instances, there is what's called a 1035 exchange. We don't want to get too technical here, but it's the ability to use the cash value from an existing plan and transfer it to a new hybrid plan. When we talk about hybrid plans, we frequently talk about live, die, or quit. If you live long enough, you are likely going to need care, and the plan will provide a bucket or a pool of money in which you can access it for that care. If you're one of the lucky ones that goes all the way through life and never needs the care and you pass away, the plan will then provide a death benefit to your chosen beneficiaries that is almost always equal to or greater than the amount of premium that you paid in. And if for some reason you decide that you no longer wish to maintain the plan and you wish to get out of it, most of the better plans in the market will provide some cash surrender value, in many instances, the entire amount that you've put into the plan. So whether you live, die, or quit, some or all of what you have put into this plan is going to come back out to you either in the form of a long-term care benefit, a death benefit, or a cash surrender if that is the case. So let's take a quick look at what one of these plans actually looks like. This is a 55-year-old male who put $100,000 in one-time payment into this plan. In year one, it has an immediate pool of money for long-term care benefits equal to $241,000, which can come out at $4,800 per month over a 4-year period of time. Now, that benefit will continue to grow by 3% each and every year. The death benefit in year one is $223,000 if this person were to pass away. And if they wanted to get out, they can get 77% of the money that they put in, or $77,000 back out. Now, all of the numbers that you see here are guaranteed by this insurance company. So all of this is fully guaranteed. Now, I have to tell you that 55 is really not very far in my rearview mirror. And as somebody approximately that age, I can tell you that thinking about needing long-term care is, if you're a healthy 55-year-old, is not something that you really can think about. So let's age this person 25 years. At 80 years old, it's a lot easier to begin thinking about the idea that, yes, I might need care. Now, as I mentioned earlier, this plan has a 3% inflation growth. So the pool of money at year 25, or when this person is 80, is now nearly $500,000, which can be withdrawn at $9,700 per month over a 4-year period of time. This amount will continue to grow if this person's not using their benefit. It just continues to go up each year. The death benefit's $125,000. So if this person lives to age 80 and never needs the care and passes away, then $125,000 goes to their chosen beneficiary. And if they choose to exit the plan at this point, 70% of the money they put in, or $70,000, comes to them in the form of a cash surrender value. I can tell you that the company that has the largest block of this type of business reports to us that fewer than 2% of the people that have ever bought these plans have ever cash surrendered these plans. In other words, once people have this important coverage, they keep it as a very significant part of their retirement planning. So let's talk for a quick minute about who buys these plans. Generally speaking, the ages are between 45 and 70. Part of the reason the ages don't go much over 70 is because as people begin to age and they have health situations, for a lot of people, they will not qualify to purchase these plans, as the underwriting can be stringent. The ages below 45 don't see many purchases because, let's face it, for a lot of those people, they are currently committing all of their cash to educating children and doing things like that, and they're not ready to take on the responsibility of purchasing this plan. It used to be not long ago that the average age of a purchaser of a long-term care plan was approaching 60. I can tell you each year it comes down lower and lower and is now approaching age 56. And the reason that it does that, to be honest, is because people are watching parents and grandparents and in chronic care situations and the incredible impact that it is having on families. And they recognize the consequences, and when they see what a grandparent or a parent's chronic care situation has done to family members, to family finances, etc., people are buying these things younger and younger. Obviously, people who buy a plan like this do not want to put the care situation on to a spouse, to a child, other friends, family members, etc. They also want to protect their retirement assets. And specifically, this gets really important for couples. If there are two couples sharing a pool of money and one of those couples needs care and it starts to diminish that pool of money, it can have a significant impact on the healthy spouse who does not need the care at that time. Clearly, people who buy these plans want to have options to choose from. Most people would prefer not to need to go to a facility if they need care, and I can tell you that the company that has the largest block of long-term care business out there reports to us that over 3/4 of the claims that they process are for services that are provided in the home. In other words, that I want to stay home, I want to sit in the usual chair and watch my TV with my remote, and if I need somebody to come into the house to help take care of me, that's what I want to have available to you. And almost all, I'm not aware of any of the better plans in the market that do not provide benefits both in the home as well as at a facility if a facility is needed. And as you heard earlier, generally speaking, these are not inexpensive plans. So people who buy these have a relatively high premium tolerance, and of course, they have significant retirement assets. Now, I said earlier in our discussion today that the most important thing that I hope you come away with is how important it is for you to talk to your financial advisor about your plan for chronic care. Insurance probably will play a role, but whether the insurance isn't the important part. The important part is understanding the need for a plan, what will happen if, who in the family will, how will things be handled. Have that plan ready to go, and then if insurance plays a role, then you can begin to discuss options for insurance. At this time, I have finished my prepared remarks, and I would be delighted to answer any questions that you may have. Thank you.
Michael, thank you so much. That was so helpful, I think, for everybody, especially me. I have parents at this age, and we're dealing with some of this myself. So I just cannot tell you how much I appreciate this. Okay, we do have a few questions. Is there a minimum age to purchase long-term care insurance?
That's a great question. And for many of the insurance companies, they do not issue policies below age 40. That does not mean that there isn't any out there. If somebody has somebody below 40 that they're interested in and interested in getting coverage, we would need to probably do a little bit of research, but generally speaking, 40 and above.
Okay, very good. Are long-term care insurance premiums regulated by your state of residence?
They are indeed. All life insurance, long-term care insurance products, et cetera, are all state filed. Generally speaking, it is the same plan state by state by state. There are a few exceptions out there. New York and California operate in the insurance world. They're like a foreign country. But for the most part, I live in Missouri, whether you live in Missouri, Illinois, or Kansas, generally speaking, you're going to find the plans are identical, but they are in fact all filed state by state.
Okay, interesting. Okay, great. So when there is a premium rate increase, is that increase the same for all policyholders?
It is not. It is usually done by blocks of business that the insurance companies hold. So somebody who has a plan that's 15 years old may be getting a different rate increase than somebody whose plan is 10 years old. But I do remind you, those are only on traditional long-term care insurance plans. On the hybrid plans that we've been talking about for the past few minutes, those plans provide a fully guaranteed premium, long-term care benefit, and death benefit. That never changes. It's only on traditional plans that you are seeing these rather significant rate increases.
Okay, very good. Yeah, some of our questions were about rate increases, and you did touch on that a lot during your presentation. So
good.
I'm interested in long-term care insurance, but would like to stay at home as long as possible before moving to a nursing home. Will insurance cover at-home care?
Great question, and the quick answer is yes. And as I mentioned, the largest provider of long-term care benefits out there reports that more than 3/4 of the claims that they process are for care that is provided in the home. So just a quick aside, I have significant longevity in my family. And so I can go back to my great-grandparents who I visited in nursing homes when I was obviously very, very young. And back then, there wasn't any insurance and there were no options. Either the family took care of you or you went into a nursing home. Today, nursing homes are completely different, having various levels of care, et cetera. Most claims that I see start with services being provided in the home until the point comes where what can be done in the home is not satisfactory and somebody has to move to a facility. But the quick answer to the question is absolutely, claims are paid for services provided in the home.
That's great news. Okay. I'd like to compensate my adult child for providing me with in-care home. Will the long-term care policy cover that?
It will if you buy an indemnity plan. So reimbursement plans, as I mentioned, require receipts. So you would actually have to have a receipt from a caregiver coming to your home. It would be turned into the insurance company and they would reimburse that receipt. In an indemnity plan, the insurance company pays whatever your benefit is. So if it's a $5,000 a month benefit that you have and you qualify for benefit, they send you $5,000. If you want to use that money to take care of a child or whatever you want to use the money for, that is entirely up to you.
Wonderful. All right. That probably applies to a lot of people. So
indeed, especially nowadays.
Definitely. I'm interested in long-term care insurance, but I'm unsure how the claims process will work. Is it worth the trouble? You did touch on this a little bit, but is there anything else you want to add about that in the claims process?
I will tell you this. experience here is that claims go relatively smoothly. And the reason for that is, as I mentioned, there's two ways you qualify, whether it's a cognitive impairment or your inability to do two activities of two of six activities of daily living. And both of those situations are certified by your own doctor. So the insurance company sends a form to the doctor completes the form and certifies that you cannot do two of six activities of daily living. The claims process starts. It's not like medical insurance where you hear all the time that somebody had a really difficult time getting the insurance company to pay for a certain medication or a certain treatment or what have you. This is a lot more straightforward, and my experience is that the claims process goes pretty smoothly.
Well, that's wonderful too. The last question we had is, how does health figure into the underwriting process?
That's a good question. And I will tell you that the underwriting for long-term care insurance is much more stringent than, say, for life insurance, and different. Let me give you a quick example. If you are in perfect health, but because of an injury or something, you happen to use a cane for walking, for life insurance, there's every possibility we would be able to get you the best available rate from an insurance company because you're in super health. If you use a cane or anything to help you mobilize, you would not be able to get long-term care insurance at all. So it's a very different underwriting process, and a much larger number of people who apply end up rejected. I will also tell you one other thing. Part of the reason that rejection rate is so high is because people way too often wait way too long. And now somebody's in their 70s and they've got some health issues and they've now decided, gee, I should have bought that. I'm going to try to get it now. It doesn't usually work out too well for them. Best is to buy this as early as possible and make it a very important part of your retirement plan and your chronic care plan.
So finding that sweet spot where you're not too young to qualify, but not too advanced where you're already experiencing health issues.
I would submit to you that most of the financial advisors that we speak with, they address this with every client they have who's 50 or older.
Okay.
And make it a very regular part of their review with their clients, because that's when most people have reached that point where it's time to start thinking about a chronic care plan.
Well, those are all our questions. If anybody has a question later as you're rewatching this or you think of something, you can email me at marketing@elevate-wealth.com, and I'll make sure that Michael and Dan get your questions. And then I'm going to share my screen real quick. Let's see if this works. Can you all see my screen? See. Is that working?
I'm not seeing your screen, Betsy.
I am not.
Okay. Let's see. There we go.
Ah.
All right. So I just wanted to share, this is our website, elevate-wealth.com. And you can go up to the box on the right-hand side and click it and scroll down to attend webinars so that you can see all the webinars we will be holding in the upcoming months. We're just so thankful. Michael and Dan, thank you so much for all of your expertise today. And then you guys might recognize Michael and Dan because on our YouTube channel, and if you look for Elevate Wealth Advisory here on YouTube, you'll find our YouTube channel. And once you go to that, you'll see our WealthWise video series. And here we're featuring different topics every month, like we do for our webinars. But Michael and Dan have been featured these last couple of weeks talking about long-term care insurance planning. So it's been very, very helpful. We've had great feedback from people already. You'll see this one here, episode 25, qualifying for long-term care insurance. And then also our Facebook page is a great resource for upcoming events here. You can go to Elevate Wealth Advisory on Facebook and find us there, and you can look at events, and you'll also see all of our upcoming webinars, any retirement planning today classes that we're going to be holding. And so that's a great resource as well. Dan and Michael, thank you again for all of you, everything you do for our clients and for us. We're so appreciative of you, and we look forward to a great partnership in the future.
Thanks so much for having us. We really appreciate it. Thanks, everybody, for listening in.
Thanks.
Thank
Have a
you,
wonderful
Betsy.
day.
Take care.
Take care. Bye.
Bye-bye.